Right now, there's something unfolding in the gold and silver space that most people won't truly grasp until it's already in the rearview mirror. Records are falling, inventories are being quietly drained, and the narrative you'll hear blasted across the biggest financial media outlets is not the narrative that actually matters, because the real question isn't what's the price today. The real question is, why is this market acting like it's in a rush? And who exactly is behaving as if time is suddenly running out? Before we get into the data, let me be very clear about something. If you've been watching these videos and getting value from them, my analytics keep flashing the same uncomfortable reality. Most of you are watching, but you still haven't subscribed. If you respect the work, hit the subscribe button right now and leave a quick comment that says, "Our John AG," so I know you're part of the core community that actually supports independent analysis. Here's what we're digging into today. We're breaking down the recent price surge. We're separating the physical market from the paper market. We're walking through why industrial demand is rewriting the rulebook. And we're connecting all of that to a geopolitical shift that almost nobody on television wants to explain in plain, honest language. And yes, there's a reason this video sounds like an alarm bell. Because if pressure keeps building the way it's building right now, the next stage won't feel like a typical bull run. It will feel like the market finally admitting something it's been denying for a very long time. Quick reminder before we go deeper, I've left bonus resources for you in the description, including access to the premium WhatsApp channel and the option to join the channel membership. If you want deeper research and faster updates that don't belong in a public video, that's where they are. All right, let's start with what's already obvious to anyone paying attention. Gold is pushing into fresh highs. Silver is holding levels that would have sounded absurd not that long ago. And the strangest part, the market doesn't feel fragile. It feels supported by something far heavier than hype. When prices break into new highs, the amateur reaction is, it's too late. The professional reaction is, this is how real trends announce themselves. And here's the trap. The same media outlets that ignored silver for years suddenly appear the moment price moves, not to educate you, but to calm you, to warn you, to suggest it's overextended, to imply you're chasing. But if this were just retail enthusiasm, the physical market wouldn't be flashing warning lights. Yet those warning lights are very real, showing up not in memes, but in supply chains, delivery behavior, and the quiet decisions of the largest players. Let's focus on the physical side for a moment, because this is where the story gets interesting. Mints and refiners don't slow or pause production of smaller bars because they feel like taking a break. They do it because they're running at full capacity. And when capacity hits a ceiling, the market doesn't wait patiently. It starts competing aggressively for whatever already exists. This ties directly into something you can miss entirely if you only stare at price charts. Industrial demand for silver is no longer a side note, it's the main course. Think about that for a second. Solar panels don't invest in silver, they consume it. That silver doesn't get stored in a vault, it gets embedded into products, grids, rooftops, deserts, and once it's dispersed like that, it doesn't come back easily, if it comes back at all. So when people say silver can't do this, silver can't move like that, they're speaking from an outdated framework where silver was primarily a monetary metal. But we no longer live in that world. We live in a world where silver is also a strategic industrial input. It's inside the energy transition, inside data infrastructure, inside electronics, inside advanced manufacturing. Quietly essential. Here's the twist. While demand has remained persistently strong, supply hasn't responded the way a textbook model would predict. The market has been tight for years, and that matters. You might be wondering, if shortages are real, why didn't price explode sooner? That's a fair question, and the answer is exactly why this moment is so important. Paper pricing can stretch reality for a long time, until it can't. A paper market can quote a number. A physical market has to deliver material. That difference sits at the heart of this entire discussion. Paper markets are built for liquidity, hedging, leverage, and trading. Physical markets are built for ownership and use. When those two stay aligned, price behaves normally. When they drift apart, you get strange behavior. Prices rising even as equities weaken, inventories draining even while headlines insist there's plenty of supply. Now let's talk about inventories, because this is where discomfort starts creeping in. When you watch metal leave major depository systems ounce by ounce, day after day, that signal isn't panic. It's preference. Someone is choosing metal in hand, metal in vault, metal they control, over a promise on paper. And when that preference spreads beyond individuals and into institutions, the entire game changes. Stay with me here, because this is where many creators drop the ball. They either scream manipulation without evidence or pretend the system is flawless. Reality is far more interesting. We know large paper exchanges have a documented history of questionable behavior. There have been criminal cases, massive fines, and even jail time related to tactics like spoofing in metals markets. When penalties are measured in the hundreds of millions, that's not conspiracy, it's documented fact. And the lesson is simple. Price is not always pure discovery. Sometimes it's engineered flow. But here's the key point almost nobody wants to say out loud. Even if paper markets can influence price in the short term, they cannot manufacture metal in the long term. So the real question becomes this. Are we approaching a point where physical demand forces the paper market to acknowledge reality? This is where the current cycle starts to look different from the past. In previous spikes, think earlier eras when silver surged, speculation and leverage played a huge role, followed by brutal unwinds. This time, the demand stack is heavier. You've got industrial consumption, investor accumulation, strategic stockpiling, and central banks reshaping reserves, particularly on the gold side. Let's talk about gold for a moment because it anchors the broader monetary shift. Central banks have been consistent buyers. That's not trivial. Central banks don't buy gold because it's fashionable. They buy it to reduce dependence on someone else's promise. Gold is insurance. It's geopolitical ballast. And when central banks keep accumulating even at elevated prices, they're telling you their risk managers are not relaxed. Now connect that to the macro backdrop. Global debt has exploded. No matter where you land politically, that fact carries consequences. Massive debt changes incentives. It pressures currencies. It distorts interest rates. And it reshapes how investors define safe. Here's the uncomfortable reality. When debt grows faster than real productive capacity, systems rely on quiet solutions. That usually means inflation slowly erodes purchasing power while yields struggle to keep up. That's the environment where hard assets stop being a hobby and start becoming a strategy. Now I'm going to say something that will irritate both extremes. Not every price move is manipulation, and not every institution is evil. But it's naive to pretend incentives don't matter. A financial system built on paper promises feels threatened when people shift purchasing power into real, unprintable assets. Because once wealth moves into physical form, it becomes harder to steer with press releases and policy statements. That's why messaging gets strange right when demand gets serious. You'll hear things like, silver is in a bubble, gold is too expensive, it's risky now. But rarely do they ask the deeper question, risky compared to what? Risky compared to currencies that can be created without limit? Risky compared to bonds that depend on discipline in a world lacking discipline? Risky compared to equities priced for perfection while geopolitics turns into a high-stakes chessboard? I'm not here to sell doom. I'm here to translate signals. And the signals right now suggest the market isn't just repricing metals, it's repricing risk itself. This brings us to the why now. Why are industrial users locking in supply? Why are investors returning to metals even as other asset classes remain elevated? Why are governments building alternative payment rails? Why are inventories moving? And why does it feel like the ground is shifting beneath us? Start with the simplest driver, consumption plus scarcity plus time. Developing a mine takes years. Permitting, financing, construction, refining, it all takes time. And silver is often produced as a byproduct, meaning you can't simply crank production higher on demand. So when demand accelerates, supply lags stubbornly. Add the second driver, electrification and digitization. Every new solar installation, every grid expansion, every data center, every EV rollout pulls silver into the real economy. Not all of it, but enough that deficits stop being theoretical and start becoming visible. Add the third driver, trust. The world has watched sanctions, reserve freezes, trade conflicts, and shifting alliances, and many nations have drawn the same conclusion. If your reserves depend on someone else's permission, they're not fully yours. That's why we're seeing gradual movement away from single currency dependence toward diversified settlement systems and gold as a neutral reserve. This is where silver becomes especially interesting. Silver sits at the crossroads of monetary psychology and industrial necessity. Gold is the metal of central banks. Silver is the strategic metal of everyday systems. Gold is the reserve of kings. Silver is the wiring of the modern world. Now let's address a common point of confusion. If silver is so important, why is it so volatile? Because it's a smaller market. Marginal changes matter more. A relatively small shift in investment demand colliding with industrial demand can create squeeze-like dynamics. That volatility scares people out right before the next leg higher, which leads to an important lesson: you don't judge a structural shift by a single red day. Healthy bull markets often include sharp pullbacks that flush leverage. The market climbs a wall of worry, advance, shake out, advance again. So if you're watching and asking, is the move over? The better question is, what does the physical market say? Because that's where truth resides. If mints are maxed out, delivery behavior is shifting, large bars are moving, deficits persist, and central banks keep buying gold, those aren't daily fluctuations, they're regime signals. Let me set a cliffhanger. Later, I'll explain why the next phase of silver may not be driven by retail investors at all, but by procurement departments and national strategies. And if that's the case, the psychology of dips changes entirely. First, we need to address the elephant in the room: paper exchanges. Many viewers ask, is the paper game ending? The honest answer is that paper markets only lose relevance when enough participants demand physical delivery or stop treating paper claims as equivalent. We're seeing early signs of that belief shifting. Metal leaving major systems isn't instant collapse. It's a warning light that trust is being recalibrated. Paper markets are great at setting reference prices. They're terrible at handling a rush for delivery. They're not designed for everyone to show up at once asking for the real thing. So the question isn't whether paper markets can exist. They can. The question is whether they can dominate when physical supply is tight and strategic demand is rising. Zooming out to geopolitics, this is the part that deserves your attention. The global system is experimenting with alternatives to the old trade architecture. Call it multipolar, fragmented, or messy. It's happening. Countries want optionality, and optionality supports gold. Indirectly, it supports silver, which rides the same trust wave while benefiting from industrial demand. Now, a misconception to clear up. Does a new settlement system mean the dollar disappears tomorrow? No. Currencies don't vanish overnight. They erode. They share space. They lose monopoly power. The dollar can remain widely used while still losing purchasing power. Those aren't contradictions. Think of a currency as a measuring stick. If the stick gets longer, the same object appears smaller. When currency supply grows faster than real assets, prices rise in that currency. So instead of saying gold and silver are going up, a clearer statement is that fiat is buying less. Let's add some skepticism because real analysis demands it. There's a scenario where industrial demand growth slows. Maybe technology reduces silver content faster than expected, or substitution accelerates. That could ease pressure. But here's the counterpoint. Even if silver per unit drops, total units can grow fast enough that overall consumption still rises. Efficiency is real, but volume is relentless. Another skeptical angle: scrap supply. Yes, higher prices bring more recycling. But scrap isn't infinite, and much silver is embedded in forms that aren't easily recovered. Even when prices rise, scaling recycling takes time. So scrap helps, but it doesn't instantly solve tightness. Let's bring this back to you. This isn't an academic lecture. It's about decisions that matter. If silver is both a monetary asset and a strategic industrial input, what role should it play in a real-world portfolio? I'm not saying go all in. I'm saying think in layers. Protection outside the banking system. Optionality when other assets struggle. Upside if structural repricing continues. And to keep this community grounded, if you've had a financial win, paid off debt, grew a business, turned your life around, drop a short note in the comments. I read them, and your story might help someone else who's quietly watching. Now let's talk behavior. When gold is strong and silver is strong, but silver swings harder, what does that tell you? Gold is being accumulated as a reserve. Silver is being contested by investors and industry. Gold acts like an anchor, silver acts like a spring, and when that spring releases, moves can be explosive. Here's a simple framework I use: 3 buckets. First, physical tightness, availability, bottlenecks, capacity limits. Second, institutional behavior, official buying, major flows, depository movements. Third, macro pressure, debt, rates, currency, confidence, geopolitics. When all 3 align, you get moves that aren't easily reversed by headlines. Right now, all 3 are aligned. Here's the uncomfortable part. Structural moves don't need your permission. You may feel late while the market is still early in adjusting to a new reality. Watch mainstream psychology. When a move is ignored, it's early. When it's mocked, still early. When it's cautiously acknowledged, it's maturing. When it's screamed daily, it's late. We're not in the screaming phase. We're in the they can't ignore it, but they want to control the narrative phase. On settlement systems, keep it simple. Countries that trade heavily want reliable settlement. If they can settle with something tied to real value, they reduce risk. Gold has always served that function because it's nobody's liability. Motive matters more than names. Reduce dependence, increase trust. If that continues, gold stays supported, and silver often follows, sometimes slowly, then all at once. Here's a practical cliffhanger. What happens if, during a future panic, investors look at stocks, bonds, real estate, and decide the only place they trust is hard assets? We've already seen hints. Days when risk assets wobble while metals stay firm. That's not normal in the old playbook. If that decoupling grows, metals stop being just a hedge and start becoming a destination. Now let's talk market plumbing. Futures still anchor price discovery, but stress shows up when delivery demands rise and available stocks are thin. When claims stack high on limited deliverable inventory, the system depends on most participants settling in cash. That works until it doesn't. And what changes the equation is strategic demand. Procurement departments don't care about trading games, they care about continuity. If they fear shortages, they buy early overorder and build buffers. Buffers destroy lean inventory systems. That's how scarcity turns real. Quick creative shout out. If you want real silver success stories, how everyday people turned smart positioning into real outcomes, there's a separate channel linked in the description. Check it out and subscribe. Seeing wins helps you stay disciplined when markets test your resolve. Back to the core theme. Trust is migrating from promises to assets. You see it in land, energy, commodities, but metals sit at the heart of money itself. Gold is the benchmark. Silver is the lifeblood. When both move together, it's not noise, it's repricing reality. One practical objection. If silver is bullish, why aren't all miners exploding? Because miners are businesses. They face cost inflation, energy risk, political risk, permitting delays, dilution. The metal reflects truth. Equities translate it. Sometimes late, sometimes distorted. Let's tighten the focus. 3 things to watch in coming months. 1. Do premiums and availability stay tight after pullbacks? 2. Do official buyers remain active at higher prices? 3. Do inventories keep draining from major systems? If yes, this isn't a chart, it's a regime. Debt and rates matter here. High debt forces choices, painful austerity or quiet inflation. History favors the quiet path. That erodes cash purchasing power and pushes people toward assets that resist it. That's why metals can rise even if a currency remains widely used. Make this personal. You don't need perfect timing. You need resilience. Trading and allocating are different games. Right now, the allocation case is being reinforced by structural demand and structural mistrust. On manipulation, what's changing isn't its existence, it's the cost. Holding price down is like pushing a beach ball underwater. It takes effort, and when pressure releases, it can overshoot. Persistent physical demand raises that cost. That's why this moment matters. This isn't about one country, it's global. Small shifts in marginal demand move yields, yields move valuations, valuations wobble, and hard assets gain appeal. Now for the viral punch. What if the next shock isn't a recession headline, but a delivery headline? A major industrial buyer locking long-term supply, a mint limiting products, inventories crossing psychological thresholds. Those moments flip perception, and when perception flips, supply is often already gone. 2 questions for you. Do you think silver's next move is driven more by investors or by industry securing supply? And if silver pulls back sharply for a week, do you panic or plan? Drop your thoughts below. Remember, efficiency doesn't cancel volume. Mining supply lags. Tightness can last longer than expected. Watch the gold-silver relationship. Gold often leads, silver catches up in compressed bursts. Here's the final cliffhanger. When the narrative flips, it won't feel gradual. It'll feel like everyone arrives at once. If you want deeper breakdowns, the members-only videos go further with charts, timelines, and scenarios. The premium WhatsApp channel is there for fast updates when markets move. Strategy mindset to close. Expect volatility, respect structural repricing, avoid emotional decisions, build a plan, understand your risk, don't let headlines whip you around. Bonus resources are in the description, membership and WhatsApp for deeper access. One last reminder, share your success stories. Even a short note can help someone else take control of their finances. And if you want to support original analysis, help eliminate copycat channels. Subscribe, comment John AG, and let the algorithm know this community is real. Final thought. The next time you see a scary headline claiming silver has topped, ask yourself one question. Did the physical market loosen, or did the paper narrative get louder? Those are not the same thing. If this helped you, subscribe, keep the discussion going in the comments, and I'll see you in the next one. Quick disclaimer, this video is for educational purposes only and reflects my personal opinions. It is not financial advice. Always do your own research or consult a qualified professional before making any investment decision.